Everyone is talking about Roth. Convert to Roth. Open a Roth IRA. Do the backdoor Roth. Execute the Roth conversion ladder. And I understand why. The idea of tax-free money in retirement is genuinely powerful. I am not here to tell you Roth is a bad idea. I am here to tell you that for millions of Americans who spent their careers building serious wealth inside a 401k or traditional IRA, Roth is the wrong conversation. Because there is a two-part strategy, completely legal, IRS published, hiding in plain sight, that does not just match what Roth delivers. It beats it. No income limits, no contribution limits, no required minimum distributions, ever. And the people who know about it, they are not talking. I'm James Caldwell. In the next 10 minutes, I'm going to show you both parts of this strategy, how they work together, why the result is superior to a Roth conversion for most retirees with $1 million or more, and why the window to execute it is open right now, but not forever. You spent 30, maybe 40 years doing everything right. You maxed your contributions. You stayed in the market through the crashes. You built something real, $1 million, maybe more, sitting inside a 401k or traditional IRA. And now your financial advisor is telling you to convert it to Roth. Here is what that actually means. To convert $1 million in a traditional IRA to a Roth IRA, you pay income tax on every dollar you move. At current rates, for a married couple in the 22% bracket, that is $220,000 handed to the IRS before you see a single dollar of retirement income. The money leaves your account, never to be compounded again. You will never recover that $220,000 from the Roth, because the Roth's growth only compensates for what you paid in taxes if the tax rates rise dramatically in the future, which is not guaranteed. And here is what your advisor almost certainly never mentioned. The Roth conversion triggers two hidden tax bombs. First, IRMAA. Every large Roth conversion spikes your income for that year. That spike can trigger Medicare surcharges, income-related monthly adjustment amounts, adding $800 to $9,600 per year per couple to your Medicare premiums. For a 10-year conversion plan, that is $8,000 to $96,000 in hidden surcharges that never appeared on the Roth conversion spreadsheet. Second, Social Security. The income spike from a Roth conversion pushes your Social Security from partially taxable to 85% taxable in the same tax year. You pay the conversion tax, then you pay more tax on your Social Security. Two bills from one transaction. The financial industry sells Roth conversions because they are simple to explain and easy to execute. But simple and optimal are not the same thing. The freight tax train is coming, but you don't have to buy a first-class ticket. What if there was a way to pull money out of your traditional 401k or IRA right now before you turn 73 and pay zero federal income tax on it, and then reposition that rescued capital into a structure that grows tax-free, compounds tax-free, passes to your heirs tax-free, and never forces you to take a distribution on the government's schedule? That is not a Roth. That is better than a Roth. Here is how it works. The first part of this strategy is called standard deduction arbitrage. For a married couple, both over age 65, filing jointly in 2026, here is the deduction stack. Standard deduction, approximately $30,000. Additional age deduction for both spouses, approximately $3,300 combined. New 2026 senior bonus deduction, One Big Beautiful Bill Act, signed July 4th, 2025. $6,000. Total, approximately $39,800. If your only ordinary income in a given year is a withdrawal from your traditional 401k or IRA, and that withdrawal stays at or below $39,800, your federal taxable income is zero. Not reduced, not sheltered, zero. The government cannot collect a tax that subtraction has already eliminated. Now let me show you what this looks like over time. A couple, both 65, retired, $1 million in a traditional IRA, enters the Pre-RMD window. Between retirement and age 73, they have 8 years before the IRS starts forcing mandatory distributions. Year 1, they pull $39,800. Federal income tax, zero. Year 2, another $39,800. 0. Year 3 through 8, same. 0, 0, 0, 0, 0, 0. 8 years, $39,800 per year. $318,400 total extracted from the taxable system at 0% federal income tax. Permanently removed from the IRS's mandatory distribution machinery before the government's schedule ever activates. And here is what most financial content stops before showing you. That is just Part 1. Part 1 gets the money out of the taxable system at zero cost. Part 2 determines where it goes and what happens to it for the rest of your life. Once that money leaves your 401k or IRA, the income tax event has already occurred, or more precisely in this case, has been zeroed out by your deduction stack. But now that capital is sitting in a taxable account. 3 new problems appear. Problem 1, capital gains taxes on any future growth. Every dollar of investment return in a taxable brokerage account is either ordinary income or capital gains, neither of which is tax-free. Problem 2, the capital is inside your taxable estate, subject to probate, attorney fees averaging 3 to 5%, and public record. Problem 3, no tax-advantaged growth going forward. The money you rescued from the IRS is now growing in a structure the IRS can still tax. This is where Part 2 enters, the protected tax-free container. A properly structured IUL, Indexed Universal Life Policy, governed by IRC Section 7702, is a Tier 1 asset. The same classification banks use for cash and U.S. Treasury bonds. J.P. Morgan Chase, Bank of America, Wells Fargo, they hold billions in this exact structure on their own balance sheets. They call it BOLI, Bank-Owned Life Insurance. What the protected tax-free container does that Roth simply cannot match: no contribution limits. You can fund it with $50,000, $100,000, $200,000 per year. There is no annual cap. No income limits. There is no income phase-out, no backdoor required, no RMDs ever. The IRS cannot force a distribution from a properly structured life insurance policy. Not at 73, not at 83, not ever. Zero floor growth. Under IRC Section 7702, if the market index goes up, you earn more. If the market goes down, you do not lose any money from that index performance. No negative years. Tax-free distributions via policy loans. Not a taxable event. The IRS never sees it. It does not trigger IRMAA. It does not push Social Security into the 85% taxable zone. Probate-free transfer. The death benefit passes directly to your named beneficiaries, outside the courts, outside public record, in days, not years. That is not almost as good as Roth. That is better than Roth. And the combination of standard deduction arbitrage in Part 1 means you get there without paying the conversion tax bill that makes Roth conversions so expensive. On July 4th, 2025, the One Big Beautiful Bill Act was signed. Tax rates permanently extended, the new $6,000 senior bonus deduction added. For the first time in nearly a decade, you can plan with absolute certainty. But certainty does not give you more time inside the pre-RMD window. If you are 65 today, you have 8 years. If you are 68, you have 5. If you are 70, you have 3. Every year you wait is another $39,800 you could have rescued at zero tax, gone, permanently. The freight tax train does not slow down while you think it over, and the protected tax-free container, once optimally funded, takes time to structure properly. The sooner you start, the more it works in your favor. If you are sitting there thinking, I've been doing everything right, I saved, I built this, and now I'm being told to hand $250,000 to the IRS just to get access to my own money, you are right to question it. If you have $1 million or more sitting in a traditional 401k or IRA and you haven't heard about standard deduction arbitrage combined with the protected tax-free container, your advisor isn't giving you the full picture. Click the link below this video. Book a private, one-on-one 401k rescue strategy session with my team. We will look at your specific numbers, your age, your deduction stack, your asset level, your timeline. Not a sales call. A working session. Bring your last tax return and your most recent IRA statement. That's all you need. Rescue, reclaim, retire richer.